$100,000 invested over 20 years comes out to be about $750,000. And that's if you just invested it at one time and stayed invested for the whole 20 years. Now, if we want to look at those numbers again, and let's look at the best 10 days in the last 20 years. If you were to miss those days for some reason, you would only have about $360,000. That's almost a $400,000 difference in your portfolio just because you weren't in the market for 10 days. And if you look at this, if you go to the best 20 days or the best 30 days, you're looking at almost zero growth over that entire 20 years. And to understand why this occurs, you need to understand when the best days actually are. So the best days usually happen in the worst times. These days are often after periods of fear in the market or a bunch of volatility. Many of the strongest market rallies occur right after major declines in the economy. By the time the market feels a lot safer to invest in, a lot of the recovery has already happened. Markets are moving before you even have a chance to read the headlines in the morning to determine if it's a good time to buy in. And examples of these throughout history is right after 2020, the market bounced back rather quickly. And if you sold during, the pandemic, and you missed all of those gains coming back. Same thing with 2008 and even like the bear market in 2022. This is even applicable right now during the Iran war. You'll just open up your account on a, Tuesday morning and the market just all comes back to where it was after it just crashed the day before. So taking your money out is actually hurting you. Hurting your gains because you're not able to predict what's going to happen, and you're missing the best 10 days maybe of the next 10 years. You're going to miss one of the days, so it's better just to stay invested. Nobody plans to miss the best days, obviously, but that's just something that you probably have to do, is just stay invested. That's the only way you'll never miss a bad day in the stock market, is if you just have money in there constantly. The market timing trap is really popular among retail investors. I think people think that the timing matters at all. Like, they should just be buying every month and holding on forever. And timing requires two correct decisions: when to sell and when to buy. And unless you're doing this for a living, you probably don't know as much as you should to be doing this. And a lot of the times investors, especially retail investors, only think about one of those choices. I feel like I should sell, but then they sell and they have no idea when to buy back in. Do they wait a week? Do they wait a year? Right? No idea. And there's usually not much of a plan. So it's important to just not sell and hold on. And confirmation on whether you want to make one of those two choices has already happened. Like, if you're waiting for confirmation to join back in the market, you probably missed a bunch of good recovery days, and that's why you feel it's safe again, right? So you're missing the gains by waiting for the confirmation that confirms what you're thinking. And consistent investing wins over time. Just putting your money in the S&P 500 tends to beat a lot of institutional investors as well. And there's research to back this up as well. Many people wait for the perfect time, and they've been waiting for years. Nobody knows where the market's going to go next month at all. And the world is changing so rapidly with AI and technology and just everything politically. There's really no way to be able to tell what the next 5 years is going to look like. So why risk it and try to determine when to buy and when to sell? Especially in a period today with hyperinflation, you cannot afford to just hold your $10,000 or whatever you're investing in cash anymore. The value of the dollar is rapidly decreasing, so you have to put it into some kind of asset if you ever want to create more wealth. And investing is a monthly psychology. A lot of investors make emotional mistakes, whereas just disciplined ones do better. Fear causes selling, greed causes chasing losses, and that means that the biggest battle is not the market, it's actually yourself. So just buying and holding and not letting your emotions get the best of you will be better for your portfolio in the long run. And I think the final takeaway for all of this: the average investor does not need to predict the future or find the next hot stock or time the market. Avoid panic selling, stay consistent, and remember that missing just a handful of good days in the stock market can cost you almost all of your gains in a 20-year span. And obviously, I'm not a financial advisor, so if you want any investing advice, go to a professional for that. This is just my opinion on the topic. Thanks for watching.